Should I take them off?
I can sit a little bit, but should be fine. We're actually live
Okay.
now. I got one more thing I need to do. Technical difficulties all the time. So
Sure.
today, uh, we know that buyers, there's a bunch of buyers out there, and there's always they get turned down from buying a home. There's a lot of discrepancy about buyers being on the fence right now. So today we're going to uncover some a program that that can be used to help some of these buyers get into homes in 2024. So this is Marcellus Kendell, another Hump Day Real Estate with Kendell in the DMV. Welcome back once again. Hey, who do I have a lovely guest today? Who do I have as a lovely guest today?
Happy Hump Day. My name is Eric Davalos. I
All
am a
right,
loan
thanks.
officer.
Thanks a bunch for taking the time to jump on with us. And you have a wealth of knowledge. Go ahead and tell them a little bit about what you do.
Sure. I am a loan officer. I've been doing this a little bit over 24 years. I help people by way of finding the perfect product for them to buy their home.
Gotcha. Now, the the topic of this discussion, and I know you didn't really like what I what I made the thumbnail, but about home buyers with people looking to buy that have bad credit. But real quick, before we talk to those people, uh, what do you feel about this market so far in 2024?
It's an exciting market. Unfortunately, it is a seller's market. However, there's great opportunities for people that are still looking to buy homes. I really think they focus a little too much on the interest rate when they really should focus on their rental payments because, as you know, rent is 100% interest. 100% interest, when you look at that and you compare it to 6.5, 7% of what the market is bearing today, it's a no-brainer because once you become a homeowner, um, part of that payment is going to you, as opposed to your rental payment is going 100% to someone else.
So is that what you're telling the buyers when you get them? I know you get buyers. Some people might just be interested. Is that the conversation you're having, or
Absolutely.
what does that look like for you?
Absolutely. Especially if they're on the fence. And I'll give you a good example. I met somebody today where they're paying $2,600 in rent, and when I pre-qualified them to the home that they would like to buy, their payment was just over 2,900. Not a big difference, except for one thing. Yes, the rate was 6.75, but a portion of that payment will go towards them, towards the debt that they're buying the home for. Rent, they're never going to see that again. They're never going to see that payment whatsoever. They're never going to see that money anymore. When you're a homeowner, you're paying yourself each month.
So you agree with what I like to spread out there is why are you not a landlord?
Exactly. Yes, I agree 100%.
Yeah, and I agree with that because for a long time, let's get into a scenario. Let's say uh, young registered nurse, um, they get their job in the hospital, etc. Uh, they do that 3 or 4 hour shifts, and then they also decide to do another 3 hour shift at another location, which takes their initial income way above where they started. So let's just use a number, $100,000, and then they do this part-time thing that gives them another $60,000. Well, most times those people are also they're losing a lot of that income because they don't know anything about tax shelter and they don't own anything that could help with that process. And so becoming your own landlord, I feel like is a way for these folks to have have something to help offset some of them tax liability and bring some of that money back home. How you feel about that, Eric?
Well, you going into a little part of it where I'm certainly not a financial advisor, um, especially when you talk about tax shelter. However, when you talk about becoming a homeowner, you can see how that is building your wealth by way of equity. So, um, when it comes to that, yes, I certainly encourage you if you could rent, you could certainly buy. As a matter of fact, there is a brand new program that we've introduced, which is called the Lease to Own program, and that is for clients that may have found it challenging to buy in the past. It makes it an opportunity to become, you know, get their home today.
So now that you went down that path, and what does that program look like? Who is that program really for?
It's really for anyone that just missed qualifying for a regular mortgage. Okay, because ultimately the best thing for them is to, yes, get a regular mortgage, own your own home. So what the lease to own program is, it's really the second best opportunity. There's so many examples we can go through. I don't know how long your show is, but I'll go down one at a time. The first one that comes to mind is new business owners. So traditionally, when you open your business and you want to apply for a mortgage, the lender wants to see a minimum of a 2-year history. And they're going to ask you for 2 years of tax returns. They're going to ask you for a profit and loss to see what your income is and base your affordability on that information. With the FHA lease to purchase program, and I'll give you an example of two young ladies that bought a food truck in December. And so we're only talking, a few months into the business, and they did earn their pre-qualification this month to buy a $350,000 house with opening their business December 2023. That is how powerful this program is.
Gotcha. Now with that particular buyer, are you willing to go a little bit into what that looked like to qualify that buyer with someone with a 1099
Sure,
type of
sure. Well,
situation?
there was no 1099. However, this will work for a 1099 person because they are considered self-employed. But
Yeah.
this person had even more obstacles. Uh, well, these sisters, excuse me, they did not have social security numbers. What they did have is they had the ITIN number. The ITIN number allows them to file their taxes each year. So they're not documented. And normally, when someone that does not have the social security and they have the ITIN number, they normally are required to bring 20% down to purchase a home, 25% down on some occasions. With this program, 3.5% down plus closing costs will get them into the home.
Gotcha. Gotcha. And so now, so did I hear you say anything about credit or anything though?
No, you did not, and thank you for asking. So their credit profile, and it's always best to use, live examples.
Mhm.
Their credit scores were like 615, 585. With this program, if the lowest credit score that they will allow is 580.
Okay.
Now, if they have
Gotcha.
ITIN and they don't have any credit scores, you can still use this program, but we will have to use what's called non-traditional credit references. Non-traditional credit references are things that report to the credit bureau. So, excuse me, that do not report to the credit bureau, and we have to show a minimum of 12 months of payments on time. So things that don't report to the credit bureau, cell phone, car insurance, business insurance, um, anything that you pay on a monthly basis that you can prove that does not report to the credit bureau, you can use. But one of the biggest things we can use is someone's rental payment. So this program, as great as it is, one of the things that they're sticklers on is they want to see your rental history for the last 12 months.
Gotcha. So the guidelines are somewhat like the guidelines of the under 580 credit score type of situation with the contemplating factors. being able to use 12-month rental history, et cetera, to kind of get pre-approved for this.
That sounds accurate, yes, but the lowest they would go is 580. If you have a credit score. If you don't have a credit score, if you're an I-10 person, then they'll use non-traditional credit references. So we certainly always say it's always best to not have a credit score as opposed to have negative credit.
Gotcha, gotcha. And so you said it's quite, you have some more scenarios. We have about 20 minutes online here, so whatever you have to go through, we can go through.
Okay. Well, here's another live example. We have a couple that they both got out of bankruptcy. One, the wife got out in September of 2023 out of her bankruptcy, Chapter 7, and her husband will probably finish this month. But she wanted to see what she would qualify on her own. So even though she had the bankruptcy back in September of 2023, her credit score was still 619. With that credit score, with her proof of rent, with her proof of employment, she was a regular W-2 employee. With her income alone, she qualified for $190,000, which may be challenging where she wants to buy, but at least she has that option to do so. But her email to me was she's going to see as soon as her husband's done, she's going to add him to the loan to use both their incomes because in reality they want to be around 325, 350, and I'm sure they can do that together. But they could do that one day out of bankruptcy. Typically, that customer would have to put a minimum of 30% down. With this program, 3.5% plus
Gotcha.
closing costs. So when you hear some of the guidelines, and if you're familiar, they do sound typically like an FHA type of loan. 3.5% down. The sellers can contribute to your closing up to 6%. They can receive a gift for the down payment. FHA wants that to come from a family member. This program will allow anyone to give you a gift towards your down payment. I mean, we could talk about another scenario, but that's just one. That is a bankruptcy. Now, I don't have a client that just went out of foreclosure yet, but I do have clients that I've had to tell them to wait. But this program will also work for somebody one day out of foreclosure. And yeah, people do wonder how does that work? What do you mean one day out of foreclosure? If somebody tried to apply for a mortgage one day out of foreclosure, they need 30% down to buy their home.
Mm-hmm.
With this program, 3.5%. The key is they still have to show rental history for the last 12 months. And chances are, if someone's been foreclosed on, they've been out of their home possibly by the time everything gets finalized, they're renting somewhere. So they're gonna have it. As long as they have the 12-month history, as long as they're over 580 with the job, 3.5% down, they'll get into their home.
Now, of course, I guess, and this may be a crazy question, but I could ask because there's going to be somebody that. So, could this be used by somebody that already has a home, whether it's a state or something out of the state, or?
This product is for primary residencies only. However, there is part of the guidelines where if somebody that is currently a homeowner can buy their primary residency with this program, which means that they're leaving behind the current primary residency. They could rent it out. The next home they're going to go into, instead of the 3.5% down payment, they do require 5% down payment. But again, this is a program, the next best option. If you could do it with a typical traditional mortgage, that's going to be best for you. But if you can't, second best option.
So let's talk about that with what you just mentioned.
Sure.
Why is it better if the individual can do it with the traditional mortgage?
Well, from day one, they're going to be homeowners. Everything's going to be in their name. This program is called Lease to Own. So even though they do have an equitable interest in the home,
Mhm.
They're not going to be homeowners until they do a refinance down the road. With a mortgage, with a regular mortgage, they're homeowners from day one. There's nothing else for them to do down the road. That's why when the clients come to my office, we review their documentation. Sometimes they actually have gone to another lender and they think they cannot buy. I review it, and this program got a lot of attention, and that's what their goal is. But then after reviewing it, I said, wait a minute, you don't need this program. You could use a regular FHA loan, and this is how. Um, and I can't speak for where they went before. I can only speak of the information that I see. And if I can see that you can qualify for a regular mortgage, that's what's we're going to give you that option.
Now, now, what's the benefit to to lenders for FHA for providing this type of programs? Being, I
Um,
mean, other than the fact that we know we want to get people into home ownership, but these folks, if they could they're a little bit on the risky side. So why do we think that this program have came to life like this?
that's a very good question, and that's a question that I'm going to ask our account executive because that's actually one of the questions I did not ask. I I've learned of this program back in September,
Mhm.
and I just started marketing it in 2024 until I
Gotcha.
got comfortable with it. But you know, I don't know the answer to that, but I will find out for you.
Gotcha. I feel like it may be and depending on when it actually all came out, it may have been the foresight of actually seeing the slowdown of buyers coming into the market, maybe with problems with with their credit issues and all of these other things that are coming down the pike because of the way the last couple of years have been. Maybe that's maybe that might be part of it.
It could very well may be. I mean, certainly they're there to assist and help people become homeowners. They see the advantage of getting more and more of the population to become and invest in themselves down the road. But that was a very good question. I'll have to find out for you what
And the
their ultimate
fact
goal is.
and the fact also that companies like Landis and American what was that home buyers all got into the business to buy houses and
Mhm.
then put these same applicants into those houses, but they had to put up the money to buy these things. So maybe that's partially where the idea came from as well. You had all these other big institutions saying, "Hey, we're going to get in the market and help people get in the houses." I guess it'll be a thing of why wouldn't a lender also directly do that?
Right now, I could not speak about those programs, but I can tell you the people that I've interviewed over the past couple of months. There's certainly a lot of programs, and you could use the search engine and put in rent to own, lease to own, and there's so many different variations. And those
Mhm.
variations are not this product. They are not. There's a couple in PG County where they've been in a supposedly rent to own contract for about 4 years. And when they signed that contract, they were going to buy their townhouse for $300,000. However, as we reviewed it during our appointment, if they were to buy it today in 2024, that price went from 300,000 to 380,000. Also, when they if they happen to re-sign this contract again in August, their payment's going up an additional $800. That's a lot of money. This program is certainly not that. That document that I mentioned earlier, the equitable trust, equitable interest in the property, that assures that you're going to be purchasing that home. And let's just say there's a settlement today, okay? And the clients buy it for $300,000. That's it. It's that number is not going up. And let's just say in 3 years from now, they're able to refinance into their own mortgage, put everything in their name, and we hope in 3 years maybe that property will go to 350. Right? There's $50,000 of equity that they don't have to share with anybody. That's theirs. Every monthly payment that they've made is chopping away at the principal. So with the equity plus the principal that they've been paying each month, excuse me, that should make it very easy for them to refinance into their own name. Very different from what you see out there um, everywhere else. This is a very unique, beneficial product for the borrower.
It sounds like it. Now, do they have to come back to you? Do they call whomever the loan is it sold or is it kept in house? How does that work if they when they're ready to refi?
Well, we would hope and we would love for them to come back to us, but we always know that's not the case. Um, but no, that is certainly our hope that they come back to us and they let us help them again refinance it into their name. But they are free to do and work with whomever they want to. Um, and what I failed to mention to you when you're mentioning these other companies that actually buy uh, some homes and put their clients into those homes, with this product, they can buy whatever home they choose. So there is no inventory that we have or that the lender has that they have to buy. Because I do get that question quite a bit from my clients. And I say, no, once you have your pre-approval letter, you and your agent are going to go out, shop around, find the home that you want to buy, and then the process starts from there. Nobody's going to tell them what to buy.
That is a much better situation. Everything I've heard you say so far is much better than having to go through landers because one of the big things that's a big difference is the amount of money you also have to put down. And on those programs, the money down is a lot higher. Um, and even if you go to a homeowner directly who wants to do lease with option to buy, you could be in an arena, let's say somewhere in Baltimore City, where that's $100-some thousand purchase, and for 3.5%, you only need about $4,000 or $5,000. These folks will ask you for $8,000-10,000 to do the deal. And the catch 22 with that is if and this is what folks don't really need to understand about the lease to own that they're seeing on Craigslist and other places with the original homeowners is that when you put that $8,000 to $10,000 down, you have to remember you were in a lease. You have not taken that option to buy yet. And if you default on that lease, you will go to rent court and lose all of your money. I've had someone do that before.
Well, again, this is very different. As I explained to you, you could, from day one, your payment is going to be broken down into principal, interest, taxes, insurance, mortgage insurance, and a little portion will go to a nonprofit that's helping the transaction happen, make the transaction happen. So Coastline Mortgage really took the bull by the horns and just went running with this program. And one thing that I did not share with you, Coastline Mortgage, they pay for our clients. We pay for our clients' appraisals up front. That's not something that we're going to reimburse you for. It's something that since 2019, since the inception of the company, uh, we've decided to do for our clients. Now, if there's two appraisals that need to be done, you're going to pay for the second one, but we're going to pay for the first one.
Gotcha. Now, something just came to my mind because it's real big. I think they moved the date to August now. Buyer's agent commission. How are you guys dealing with that with this particular program?
Well, we're not agents. However, we do want to make ourselves available to all of the agents that we work with. And it's gonna take a little bit more um,
Well,
analysis
well,
because we're gonna have to vet the buyers a little bit more to see if they have the funds to make that difference up if need be. Since the
gotcha. So it is just the basic difference of how much money the buyer actually has in order to be able to pay for the realtor's commission. You guys don't already there's not already something in there like Fannie and I think have doing where they're doing 2% or something uh, towards closing costs, something like that. Trying to make some type of adjustments for the expense that the buyer may incur
right, well,
after
for,
August.
like I said, for now, we're just making sure that we double and triple check our buyers, making sure that if this becomes an issue, that our buyers are in good position should they have to flip that bill.
Gotcha. Gotcha.
Mhm.
Gotcha. And so you want to share one or two more scenarios, or
Sure.
do you have anything else you want to?
Well, we certainly can. Now, this program, you can have two borrowers. Oh, well, here's one very interesting. So typically, if you owe for 2023, let's just say a business owner, typically they're used to possibly making payments should they owe the IRS for 2023. They'll make payments each month or quarterly payments to rectify that. On a regular mortgage, there's some rules that we have to abide by, like they'd have to show the agreement of that installment plan. And if it's an FHA loan, they're going to want to see at least three minimum payments. With this program, uh, when you look at the credit report, and if there is not a tax lien on the credit report, then we're going to move forward with that file. That's according to the guidelines. So the fact that they owe is not going to stop the deal. And we won't have to wait the 3 months, excuse me, proof of payment, and we won't have to see the, the payment plan. Because remember, this is FHA lease to own. It's not a purchase, so that will not be a factor. So I found that out actually a couple weeks ago with one of my clients because I thought we'd have to wait until maybe August until they're in a payment plan. But I reviewed it with our account executive in underwriting, and according to the guidelines, they're fine. So they're shopping now.
Nice. So again, I know this is not the exact same, but
Right.
some of the the underwriting or what have you is almost just like that under 580 situation, but it's better because there's a lot of things that you guys are not looking at because it's not a traditional loan that
Right.
will allow people to get into the situation, and that's the beauty for a lot of it. Because I've actually had about three to five people have came to me just in the last couple of months, whom were concerned about credit and some other thing, and even their employment, although they have some income. Now, so and me saying that, it just came to my head. Somebody has fixed income situation.
Okay.
They can use this program.
As long as the affordability is there, absolutely, absolutely, they can use the program. Um,
Gotcha.
Another example like I shared for you, and it kind of falls into the sisters that started their business back in December of 2023. Remember, there's only what 5 months of history there. Think about someone that is on commission. Think about maybe the cash wage earner that they report their taxes, but they get paid cash without a 1099. What we're going to do is we're going to qualify you based on the deposits over the last 3 months. We're going to ask you for the last 3 months. We're going to calculate what deposits you made each of those months. And then we're going to compare it to your profit and loss. And whichever one is less, you're going to qualify for it. If we had to qualify over the tax returns it, on a typical mortgage, that may read a little differently. But 3 months bank statements, your deposits, compared to your profit and loss statement is what we're going to qualify your affordability on.
So Uber and Lyft folks, you might be able to
Absolutely.
buy a house.
Yep, they don't have to wait to 2 years if they're depositing everything, and that's the key, depositing. Um, we do have some clientele that they may deposit just enough to pay their bills, and that's when I talk to them and say, wait a minute, I understand that you might like to hold cash at home, but if you want to buy a home, any lender is going to want to see those deposits. So please deposit all your funds into your bank to show what you're making each month.
All right. That what I just mentioned is a nice niche to go after is the Uber and Lyft folks,
Absolutely.
because they normally deposit right into the bank from their app. So they're
Great
always
point.
going to have weekly or monthly or however they decide to send that money over to the app to be able to show proof of that income.
One last thing, and I don't know if we're running out of time, but I did want to mention to you, for those that see that their scores may need a little bit of assistance and they're paying their rent on time. Excuse me. And what I mean by paying the rent on time is that they're not 30 days late. There is a company that will report to two of the bureaus the last 2 years of your rental history. And I've seen that jump some of my clients of like 40 points and within 7 to 10 days. It has helped many of my clients just by reporting their rental history. They'll get first 2 years, excuse me, the last 2 years on their credit report, and then every month after that, they'll report it. And you only need it until you buy your house.
And so, where are you licensed?
I am licensed in Maryland and Virginia.
Oh man, I need somebody down in Florida. I think this is a good
I have teammates. I
program.
have teammates. I have teammates that are licensed in Florida. Absolutely.
Yeah, so if they can use this down in the Florida area, my son is a licensed agent down there, and
Right.
this might be a good program for him to look at for his family as well.
If, if
All right,
if we don't have a license, if we don't have a teammate that's licensed in a state that we want to go into, we can. We have that opportunity to get that license.
all right. I appreciate you much for taking the time out to share this information, and I'm greatly looking forward to working with you to go out and trying to see if we can help some folks in 2024 meet their home buying needs by using this program, which I think is a lovely program compared to throughout the years when I've worked with Landis and American home buyers and some of the other folks and with their guidelines and how much money they have to put up front, etc. Really appreciate you for coming on. Do you have any last things that you want to share? Or
Well, first of all, thank you for having me. I appreciate it. I'm a newbie on the video, so thank you for treating me with kid gloves. But no, you're absolutely right. This is a phenomenal product, and I'm very happy to be able to offer it to all of our clientele. And Coastline Mortgage has given me the opportunity to present this to as many people as we can. They've certainly taken the bull by the horns and ran with the advertisement. So um, yeah, I'm just thankful that we're able to provide this for our clients.
for anybody that's actually listening to this on a podcast and not video, can you give them your phone number and also your email?
Sure. My phone number is 443-422-0284. My email is Eric, ERIC, at coastlinemortgage.com. Coastline Mortgage, mortgage is spelled out.com.
There you have it, folks. Every week we're going to come to you with something in real estate, some type of real estate news that you can use. Eric, again, I appreciate you. Followed up with you to check up on you, and we connected with something that I think is very interesting and will help a lot of people this year. It's another Hump Day Real Estate with Kendell in the DMV. All right, thanks again for being on. I'll talk to you soon.
Thank you.